Is apartment investing risky? And if so, how risky is it?
My poor dad often said investing is risky, but my rich dad said being financially uneducated is risky.
We don't know about you, but what risk are you more willing to take?
You should know that there are two big risks that exist in real estate investing or in any investing as a matter of fact, right? The first risk is asset class risk, and the second risk is execution risk.
You should always be asking yourself important questions. Questions like, does this investing in this asset class actually even work? AKA, has it been proven historically to create generational wealth? And am I working with the right team that can actually execute the business plan, the operations needed in order to get me to my targeted returns?
Absolutely, that's great questions to add, right? So a few months ago, Palm and I, we were sitting around and meeting with our dear friend, and we were chatting about his investment strategy. And of course, we couldn't help it but compare his to ours. Sorry about that.
So we've been friends for many years, but unfortunately, we're sitting at very different places financially speaking. He's taken quite a few shots in the dark, hoping to make it out big, and none of them really panned out.
And ultimately, the discussion landed on the idea of risk-taking, and our willingness to acquire risk.
You see, quite often when people start investing, they tend to overestimate the potential returns and underestimate the potential loss. This is especially true when an investment promises disproportionate returns.
We know, because we also get excited and wrapped up, in the idea of hitting that big jackpot, ding, 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 right? But, we hate to break it to you guys. Leprechauns aren't real, neither are the jackpot at the end of the rainbow, and most definitely, neither are the most, get-rich-quick schemes.
When you take a closer look at all these so-called home run deals, you can see that if you're in the right and when you hit it out big, your return would definitely be astronomical. But when you lose, you can also lose massively as well.
Yeah, and a lot of times people lose context and, fail to recognize that the probability of winning that jackpot or the number prize on the lottery tickets is minuscule.
Yet they still cling to the dream and that idea that they'll be the lucky one, the chosen one, etc.
Right, you know what? The sad part is that in doing so, they dismiss the 100% return in 5 years, or the i.e. 20% AR solid return that you can get in your hard asset class like multi-family apartment syndication. Instead, they choose to buy on trend or what they read on Instagram posts like Dogecoin or NFT that they really know nothing about.
Now, why should you care?
Well, for starters, this is an important topic all investors should evaluate when deciding what and with whom, they will be investing with.
Totally, Nan. And this is where we differ from our friend that we mentioned earlier. When it comes to investing, the Kitty sisters like to invest in an asset class that has the least likelihood of failure.
Okay, to put this in another way, we like to go after asset class that have the lowest risk profile available. So if there was a failure, it would be the failure in execution. By doing this, it means that, the only variable that determines your success or failure is your execution of the business.
That's a lot of pressure, right? Not really. If you think about it, this means that you will be better served investing in asset classes that fundamentally addresses a real need in the marketplace instead of going after the newest and the latest glitzy investment strategy out there.
I absolutely agree with this, right? Because that's how we do it. Have you ever heard of Abraham Maslow? If you haven't, he was a psychologist who is best known for his development of a system of hierarchy of human needs, which essentially lay out the necessary elements for human health, like success, and starting with most basic like food and water, and upward progressing toward ego and self-actualization. We will write the link in the show description in case you want to learn more about him.
We've all learned a lot in the past few years thanks to the pandemic. But one of the most basic level of human needs, according to Maslow, is the need for shelter. The COVID-19 pandemic brought a lot of suffering to us all, but one thing it also did was it provided a massive case study in the tune of billions of people around the world that shelter is a fundamental need.
Yeah, shelter is so necessary that the government was willing to print trillions of dollars and literally mail out checks to everyone, right? So you can see why we focus on this type of investment opportunities. It allows us to quickly identify any failures And if it doesn't work, it's not because of the asset itself. It's because of the way you execute your investment strategy in the same asset.
Well said, Nan. Cash multipliers, if that wasn't convincing enough, let's take a look at an illustrative stats. According to the National Multifamily Housing Council study, the US is short 4.3 million units of multifamily housings, and we're not going to be able to make up the difference anytime soon. During the thick of the pandemic, multifamily apartments occupancy and rent growth hit all-time highs. Net migration into our key markets such as Houston, Dallas, Fort Worth, Phoenix, and Atlanta grew even more during the pandemic, more than had previously been expected, of course. Nan, agree or disagree that we can all afford to take some small investment setbacks from time to time?
I would say so.
Yeah, so that's a common logic, right? But for example, maybe your return, instead of hitting that 100% that you were targeting, is 95. However, if you don't first answer the two questions about risk that we spoke about at the beginning of the show, then you're gonna take undue risks that can actually result in not only a little bit of loss, but also a total reset of your investment dollars. But more importantly than that, Nan, it can also lose you a ton of time.
Well, Palm, now that you touched on the stat, what about execution risk? What would you suggest?
Well, we went through this more thoroughly in previous episodes about our little known CARE strategy that we personally implement on the daily to determine if an investment opportunity actually is something worth seeking or not.
So, shall we dive into each of the letter of the CARE strategy?
Yes, C is for compass. You need a compass to guide your thoughts and actions before embarking on any journey, right? It's like plugging your Google Map or Apple Map driving somewhere you've never been before. But as a passive investor, your compass needs to be internal to keep you moving forward towards your passive investing goals.
A is for awareness. Awareness is huge in passive income investing.
Why is that, Nan?
Well, I'm glad you asked because it means that you know what you want and how you want it and what you need to do to get it. Think about it, it's like kind of like moving to a new city or even to a new state, right? You might not be familiar with the culture, the restaurants, the people, the weather, etc. But after a while, you're able to make yourself fully feel at home.
Yes, and you're settling into your routine.
You could probably walk the neighborhood with your eyes closed, right? And know how long it would take to get to your usual spots and have the right people on speed dial when you need a hand.
Or have Siri call for you. Now, when it comes to apartment syndication, this level of awareness is super important to you. You most likely won't be moving to the area that you're going to be investing in, right? We're not saying like move from LA to Atlanta, but you still want to be able to learn as much as you can about the area.
Indeed, become aware of things like demographics, surrounding areas, major employers, and rent projections will help you a ton in navigating your investment decisions.
R is for review.
Think of review step like doing all your due diligence. There are a lot of numbers and facts thrown at you in apartment syndication, but having a solid business plan will help you stay the course.
Oh, and don't forget to fully vet your potential sponsorship team, their claims, their track record. This is a big part of your due diligence too.
E is for execute.
While you're doing your review in the steps that we mentioned earlier, don't get stuck in the analysis paralysis phase. It's easy to get stuck in thinking, dreaming, and planning phase, but there comes a time when you must be ready to execute. If there's no action, there's no success. Period.
Cash multiplier, when you keep resetting to zero, compound and accumulate wealth will start to feel like standing on a quicksand, and you may not have enough time left to start over.
But don't worry, we know none of this comes naturally. The good news is we're here to help, to get you educated and learn how to mitigate risks. For more, tune into our other episodes or join the Kitty Freedom Club. That's the Kitty Freedom Club to learn how to become financially secure and independent.
And remember this, guys, you got this, and most importantly, you got us, your financial BFF. Thanks again for tuning all the way to the end, and don't forget to stay classy and risky, right? As always, remember to tell your friends about the Kitty Sister, click like, subscribe, and bell icon. We've been having a lot of fun sharing you our apartment investing journey, tips, and secrets.